Welcome to KTM Investing. Today, we are going to go over a few tax strategies to help you grow your investments smarter and reducing your tax burden. Keep in mind that this should not be taken as legal advice, as we are not tax professionals, and this information should be treated as such. Consult with a tax attorney or your financial advisor before making any investment or tax decisions. With that out of the way, we will now be diving into how to legally minimize your tax burden on investments and keep more of your money so you can grow your wealth faster. So grab your notepad and let's unlock the secrets to tax-efficient investing. One of the biggest mistakes investors make when investing is not understanding capital gains taxes and how to minimize how much you pay to the IRS. Holding investments for over a year transforms your gains into long-term capital gains, which will be taxed at a lower rate. So keep your investment for a year and 1 day to get the lower tax rate. Selling before that period results in your investment being taxed at the higher regular income tax rates. Utilize tax loss harvesting to offset gains with losses, potentially reducing your tax liability to zero. Tax loss harvesting is an effective tax-saving strategy that involves selling securities at a loss to offset gains in other investments or income. By using this method, you can help reduce your capital gains and/or income taxes. If your capital losses exceed your capital gains, you can reduce your taxable income by up to $3,000 for the year. You can also carry forward any excess losses to offset capital gains and income tax in future years. Tax loss harvesting is complex, and it's important to consult with your financial advisor or tax professional to make sure you're maximizing its benefits and adhering to any applicable IRS rules. We will cover more of this in another video. This strategy is usually used mostly by extremely high earners, so we will move on to our more common strategy, which is real estate. Real estate offers significant tax advantages, such as depreciation of assets. You may deduct depreciation expenses from your rental income to reduce taxable income, and you can also use this for second or third vacation homes that are not being used as rental property. We will include more detailed information that can be included in depreciated expenses, such as putting in a new driveway, a new roof, a deck, or even tree removal in certain cases. Utilize 1031 exchanges to defer capital gains tax when reinvesting in similar properties. A 1031 exchange is a tax-deferred exchange governed by Section 1031 of the U.S. Internal Revenue Code. How it works is, you sell an investment property, the relinquished property, and use the proceeds to buy another investment property, the replacement property, of equal or greater value. The like-kind requirement states that the properties involved in the exchange must be of the same nature or character, meaning real estate for real estate. However, there are time constraints. You must identify the replacement property within 45 days of selling the relinquished property, and acquire it within 180 days of the sale. You will then get the tax deferral by reinvesting the proceeds from the sale, and you defer paying capital gains taxes on the profit from the sale of the original property. As an investor, you should use 1031 exchanges to reposition your investment and diversify your holdings, or upgrade to more expensive properties without paying immediate taxes on the gains from the sale of the existing property. You essentially can keep buying and selling without paying the taxes if you reinvest all the proceeds from the sale, one property, into the purchase of another property without paying taxes on the sale, as long as the new purchase price is higher than the proceeds from the sold property. You can essentially use this method to go from single homes to duplexes, and eventually an apartment building, all without ever paying taxes on each of those sales. However, keep these parameters in mind. Primary residences and second homes generally don't qualify. All equity from the sale must be reinvested into the new purchase to defer taxes. A qualified intermediary is required to facilitate the exchange, and the exchange must be structured to avoid constructive receipt of funds. This method allows investors to defer capital gains taxes, facilitates reinvestment of the full sale proceeds, and provides flexibility in property selection and acquiring more expensive properties as you grow your portfolio. The tax benefits of real estate investments are unparalleled. Next, we will cover bonds, and as we know, not all bonds are treated equally by the IRS. Municipal bonds offer tax-free interest income. U.S. Treasury bonds are exempt from state and local taxes, and corporate bonds should be held in tax-deferred accounts like IRAs or 401(k)s to shield interest income from taxes. Understanding bond tax implications is essential for maximizing after-tax returns, and for the purpose of keeping this video brief, We will go more into this strategy in another video. We will cover retirement accounts. These are essential for minimizing your tax burden, as in most cases they grow tax-free, and your contributions are usually placed into these accounts from your pre-taxed income, thereby lowering your tax burden. For example, Roth IRAs grow tax-free, and you can withdraw earnings tax-free in retirement, which at the time of making this video is 67. Traditional IRAs and 401(k)s reduce taxable income today and grow tax-deferred. High earners should consider the backdoor Roth strategy. The backdoor maneuver gives you a legal way to sidestep some of the income and yearly contribution limits that are usually associated with Roth IRAs. Still, it's important to understand these limits, as they will still apply in the future after a conversion. For 2025, once you have a modified adjusted gross income over $161,000 as an individual, or $240,000 filing jointly, you are not allowed to contribute to a Roth IRA. If your income is under this amount, you can fund a Roth IRA normally and should not have the need for a backdoor Roth IRA. Keep in mind that only high earners benefit from this strategy, and you can find out more about this strategy by visiting the official IRS website. Make sure you maximize your retirement account contributions before taxable brokerage accounts to reduce your lifetime tax bill. Next up, we will cover dividends, which can be taxed in two ways. Qualified dividends are taxed at favorable long-term capital gains rates. Ordinary dividends are taxed as regular income. Pay attention to the type of dividends and hold stocks long enough to qualify for lower tax rates. Save money by understanding dividend tax implications. We will cover this more in another video. The wealthy are skilled at keeping more of what they earn through effective tax strategies by either educating ourselves on the code or finding qualified professionals to do the work. A few strategies include borrowing against appreciated assets to defer capital gains taxes, utilizing charitable trusts and donor-advised funds for tax-efficient donations, establishing family-limited partnerships to transfer wealth efficiently with minimal tax implications, and implementing sophisticated tax planning strategies to minimize your tax burden and accelerate financial growth and freedom. If you employ these strategies, you will grow your wealth at a faster pace, and taxes will not erode your investment returns. Understanding tax implications and leveraging legal deductions and credits is a necessary tool to utilize if you want to be a successful investor. If you apply these strategies, you can build enduring wealth with minimal tax impact or implications. Thank you for watching, and don't forget to like and subscribe if you found this content useful. That concludes today's video. We hope you found these tax-saving strategies beneficial. Please share in the comments what type of investor you are. Again, don't forget to like this video and subscribe for more insightful content. Thank you for watching, and we look forward to seeing you in the next video.